Vivaldi Capital Management. Welcome to a private placement life insurance conversation with Jordan Katz. Jordan is the CEO and founder of JR Katz, a local insurance boutique that helps wealthy individuals and families with protecting their wealth, minimizing taxes, and protecting against the uncertainty of the future with customized insurance solutions. Jordan, thanks for joining us today.
My pleasure. Thanks for having me.
Well, you and I have been working together for many years now, helping our clients with all types of insurance needs, along with you working with many Vivaldi advisors and clients. Lately, private placement life insurance, which we'll call PPLI for short, has become more prominent, and I suspect that'll continue. So I thought this would be a good conversation to learn more about the space. But before we jump into that, you've been in the insurance business, I think, your entire career.
Yes.
Something you're very passionate about. So maybe spend a little bit of time talking about
We won't talk about how many years.
How many years?
Long time.
But talk about what got you into the business, what kept you around for so long.
Well, background, my family was in the real estate insurance business in Chicago. And I have three older brothers, and so I kind of was relegated to the area nobody else wanted to deal in. I actually majored in insurance and risk management at the U of I and went into the family business. And then after about 4.5 years, I had an opportunity to go out on my own and start our own firm. And that was a lifetime ago.
Wow. That's great. I don't hear many people actually major in insurance.
It was unusual. Most of the people in the program, and the U of I had a good program. Most people wanted to go into actuarial work, et cetera. I was somewhat unusual, wanting to be on the client side and marketing and working with clients.
That's a pretty good run.
Yeah, it has been.
All right, well, let's jump into PPLI. I suspect people that are watching this either aren't familiar with the space, or those that are might not know as much as what we should know that's out there. How do you define PPLI?
Good question. Actually, PPLI has been around a long time. It's only been maybe the last 10, 15 years that it's really gained a lot more traction, and we can discuss why in a little bit. But essentially, private placement life insurance is an institutionally designed product. It is a variable universal life product. It is a non-registered version of what most people would call variable life. And when I say non-registered, I mean non-registered with the SEC, meaning it is only for qualified purchasers. And when a product is non-registered, it allows a lot more latitude to the types of underlying investments that can be utilized. Probably one of the biggest distinctions between a registered and a non-registered variable product is that a registered product has to have daily valuation. We call it mark-to-market daily. With a PPLI, or a non-registered variable universal life, it does not require daily valuation. So it opens up a much broader category of types of investments. You'll see alternatives. You'll see private equity, private debts becoming very popular in private placement. You'll have hedge funds, fund of funds, et cetera. So you are able to have a much broader investment platform when you're using private placement versus a regular registered variable policy.
Yeah, that typically just uses standard stock and bond mutual.
Yeah, you'll see indexes. You'll see commodity funds. You'll see REITs. There are typically one or two REITs maybe in a variable chassis. But yes, typically it's stocks and bonds primarily. Something that can be, a mutual fund equivalent.
Yeah.
They're called in the insurance world, the funds underneath a variable policy are called separate accounts. But essentially, they look, taste, and feel and operate like a mutual fund.
Yeah, it's like a regular separately managed account of a mutual funds wrapped around an insurance, or exactly. Yeah. That's right. So when did you first write your first or work on your first PPLI policy?
About 24, 25 years ago, I had been part of an organization. We were affiliated. We had our own firm, but we were affiliated with an organization that developed a private placement product. And that's when I first became aware of the ability to use it for high net worth clients, for individuals. The equivalent of PPLI has been around for a long time in the institutional world, meaning COLI, corporate-owned life insurance. Very commonly used. But PPLI developed targeting the high net worth individuals starting around 25 plus years ago.
And then over that period, as you mentioned a little bit earlier in some of the conversations we've had, you wrote policies, but it really has picked up steam recently.
And there's a lot of reasons for that. Number one, the policies that were issued 20, 25, even 15 years ago had a higher expense factor. Okay, so due to the competitive nature of things, the cost structure of private placement has come down, number one, and also the ability to have more bespoke or customized underlying investments has made a big difference in the last 5-10 years. And today the carriers, and by the way, there's just a limited number of insurance companies that offer private placement. But those carriers have now kind of opened up the doors to allow clients to recommend and bring in their own advisors to help manage the underlying assets. And what developed over the last 5-10 years is what we call separate account management, SMAs, separately managed accounts, for private placement. And we've actually helped onboard managers like Vivaldi, so that they have the capacity to locate assets within a private placement. We like to think of PPLI as just the location of the assets. It's a non-taxable location. So you have your taxable bucket, you have your qualified plan bucket, and now you have what we call PPLI. It's a non-taxable structure. It's a non-taxable vehicle for housing those assets. And when you look at it from an economic standpoint, it is extremely cost effective. The overall cost structure over the life of a PPLI contract should be anywhere from 40 to 80 basis points.
And that's all, and that includes...
That's including all the cost of the insurance element, the fee structure, the premium taxes, et cetera. So all the cost of the PPLI. That does not include the management, the management of the investments.
So from my perspective as an advisor, when I'm recommending this to a client, I want to think, okay, there's the cost of this insurance vehicle that you said, the 40 to 80 basis points, which is not high, and it sounds like significantly lower than what it was 25 years ago, against what the cost savings would be from taxes on some of these investments that we put our clients into. So talk a little bit about that delta or that spread.
Excellent. Just so you understand, private placement is not about the insurance. Okay, it is about income tax mitigation and the ability for long-term. And by the way, it's widely used in a wealth transfer scenario. In other words, using housing assets inside a life insurance contract, and that insurance contract is owned by a dynasty trust, a multi-generational entity. That's an extremely powerful tool, okay? Remember, there are 3 distinct tax advantages that life insurance, properly designed, life insurance can offer. One, the death benefit is income tax free. Secondly, the cash value, the asset value, and the growth accumulates in a tax deferred environment. And then the third leg of the stool, if you want to call it that, is the ability to access the policy value in the future without paying income tax. And that's kind of a nuanced aspect to it that a lot of people are not as familiar with. So you have tax-free death benefit, tax-deferred growth, and potential non-taxable access to the policy value in the future. And that tax characteristics, those characteristics are really what drive the use of PPLI.
Yeah, so as I think about those three stools, we should dig in a little bit more on each of them. And from my perspective, you mentioned it earlier, PPLI is maybe first and foremost, and correct me if I'm wrong, a tax location tool. So I think about my clients, we build an asset allocation for them. We think, how much do they have in stocks, bonds, hedge funds, private equity, real estate, and other various investments. Some of those are very tax efficient, like equities, if done right, could be very tax efficient. Real estate, if done correctly, could be very tax efficient. But then you have hedge funds, which are notoriously tax inefficient. You have private credit, as you mentioned, notoriously tax inefficient. Maybe even private equity sometimes could be tax inefficient. And for certain clients, a big part of their portfolio is in retirement dollars, right? So we could use those vehicles to put those tax inefficient buckets, investments into. But there's certain clients with much larger balance sheets that could never have that much money in qualified investments. And I think that's where PPLI really makes sense. Where do you see kind of the dollar amount of a client's net worth or a family's net worth where it starts to really make sense to use these types of investments?
Well,
or do you even look at it that way?
Well, we do and we don't. Because I think you need to look at it from a pure dollar amount, but you also need to look at it as a percentage of a portfolio. Mm-hmm. So if we have a client that's worth, let's say they're worth $100 million, mm-hmm. the percentage of the portfolio that they might allocate into alternatives, private equity, private debt, hedge funds, et cetera, might be much higher than somebody who's worth 30 million mm-hmm. or 40. So in that sense, it's a function of the percentage of the portfolio. But I think you kind of hit the nail on the head in that we see the majority of the use of private placement is to shelter, to mitigate the income tax effect on those tax inefficient types of assets. You're not going to take municipal bonds and put them inside a private placement. It would be foolish. But you will take private equity, private debt, et cetera, and house those, okay? And again, it's, the investment advisor that has the capability today of using the private placement life insurance or the private placement annuity, being able to use those as a location for housing certain types of investments gives a much broader, broader capacity and a much greater tools to work with to be able to use that and allocate certain types of assets into those vehicles. It adds a tremendous amount of alpha because of the fact that you're mitigating the income taxes.
Yeah. And alpha oftentimes is used in the sense of investments, which isn't always guaranteed alpha. But with taxes, you could, with some level of certainty, say that this is guaranteed alpha. Because if you really put numbers to it, and I think about it, okay, let's go back to the cost, 40 to 80 basis points. But let's say I put a hedge fund manager in there that's 100% ordinary income, or a private credit manager that's 100% ordinary income. If you're in the highest tax bracket, depending on what state you're in, you're going to be paying 40 to 50% of that to Uncle Sam. With this type of solution, you're not paying anything. So you're looking at, that's the delta, right?
Exactly. I like to use a different example, okay. But you're exactly spot on. And that is the overall slippage. I like to think of it as a percentage of the return. Instead of saying 40 to 80 basis points, let's say that somewhere between 5 to 10, 11% of the return is lost to the slippage of the vehicle. Mm-hmm. Versus in the best case scenario, what is a client? 23.8? Mm-hmm. Between if everything is long-term capital gain at 20%, you add in the Obamacare, you're looking at 23.8. So you're comparing call it 24% in a good case scenario going to income taxes versus 5 to 10% of the return.
Yeah.
So you're over time, you're talking a tremendous amount of accumulated savings, tremendous
Yeah.
tax savings.
I've had these conversations with insurance advisors over the years about the potential of using these vehicles and tapping into them throughout your life versus just leaving it as more of a generation type of solution. What are your thoughts on that? Is that something you do? How do you advise clients from that perspective?
Well, it depends. See, we always look at it from a holistic standpoint, very similar to the way you work with your clients. You look at it holistically, and that is, who's going to be the owner of this asset? Who is the best party in the familial structure? Who should be the owner? Where should those assets reside? What type of entity? Is it going to be in a dynasty trust? Is the client going to just own the assets themselves? So we have to look at all of that to determine exactly, what types of assets, where the structure, where should it be placed. One of the additional tax benefits of life insurance is that the death benefit of a life insurance contract under Section 101 of the Code is income tax free. But if that's owned if the assets are owned inside a dynasty trust, as you know, multi-generational entities don't get a step up in basis. But the tax-free death benefit of a life insurance contract is effectively like a step up in basis. So we've done analysis just comparing assets owned in a dynasty trust and the loss of the step up in basis and how significant that is over multiple generations versus holding those assets inside a life insurance contract and getting effectively that step up in basis when the insured dies. It's a very powerful advantage. So again, that's a nuance about multi-generational entities owning the private placement. I would say that with all our clients over the years, I would guess half of them, at least, have some type of multi-generational entity being the owner of the insurance contract. People often ask, they say, what's the downside of PPLI or any life insurance, permanent life insurance contract? The downside, the pros and cons, the cons is it requires patient capital. I tell clients and prospective clients, do not go into private placement if you're not willing to let the assets sit inside. You can change the underlying assets with no tax effect, okay? But don't start pulling money out of the contract for at least 10 years, ideally closer to 15. Because I like to think of the analogy as a freight train. A life insurance contract, whether it's PPLI or not, it's kind of like a freight train. It's slow to get going, but once it gets going, it's very powerful because of the tax-free nature of the accumulation over time. And that's why I say to clients, look at the PPLI as part of a wealth transfer plan, and if not, if it is something that you would want to tap in the future, okay, whether it means pulling it out to give to the next generation, okay, at a later time, or for yourself, plan on not touching it for at least 10 to 15 years. And we model it that way. So if a client says, well, gee, I understand the advantage of using it on a pure accumulation basis, but how do I tap into those assets if I want to 15, 20 years down the road? And we model that, and we show them how they can access that value. So for instance, let's say we have a 50-year-old client that has the capacity to put in, a block of money over a period, and you typically fund PPLI anywhere from 2 to 5 years, typically, because you want to get it in there working as quickly as possible. And what we'll do is we'll demonstrate the ability to pull out 90 to 95% of the accumulated value in the future. We always leave enough behind in the policy to carry some minimal death benefit as long as the person could possibly live. because that's how we avoid any tax effect. We want to avoid any recapture. So a properly designed PPLI contract, the policy should eventually pay a death claim. And as I always describe it, as long as there's $1 of net death benefit being paid when the insured dies, then you have no tax effect.
Yeah, when you kind of lower the value of the insurance, the cost of it goes down significantly. So it's
Correct.
easier to carry over time.
Yeah, if you ever see the way we design, again, I used to use the expression, a properly structured PPLI contract, you'll see that the difference between the death benefit and the cash value, that difference is called the net amount at risk. And what we try to do is lower that net amount at risk as quickly and as much as possible. And that's how we reduce the slippage, because the insurance company is only assessing mortality expense based on that net amount at risk. So let me give you an example. Let's say you have $1 million death benefit policy and the cash value is $200,000. There's only $800,000 of risk to the carrier, because when the death benefit's paid, if it's $1 million of death benefit, $200,000 of it is the client's cash value. So they only assess mortality expense on that $800,000. Now, imagine you design a PPLI, you put in $5 million over 4 years, $1.25 million a year for 4 years. And 20 years from now, it's worth, I'm going to make it up a number, $25 million. Okay? The net amount at risk at that time, the cash value is probably, if the cash value is $25 million, the death benefit might be $27 million. Okay? Or $26 million. So you've only got $1 million or $2 million of risk. Well, the cost of that, even if you're 90 years old, is so minimal compared to the massive amount of money in the contract.
Makes me think, as an advisor, there's these structures that have been granted by the government, and if you really understand them, how remarkable they can be from a wealth management perspective, and this is one of them specifically, is you're not really paying that much for life insurance. You're just creating a vehicle that's protecting the family from paying income taxes and being able to pass that along, if structured properly, effectively tax-free for multiple generations.
Yep.
So
it's a powerful tool, again, properly designed and properly managed.
Yeah.
You know, and we've seen some incredible designs. You know, where the client's netting, you know, the net is about, you know, where they've only had maybe 4 or 5% of the entire funding or the entire return lost to the slippage of the insurance contract. That's highly efficient, highly efficient.
So we've talked a lot about the pros of private placement life insurance. What are potential cons, potential concerns about regulatory changes in the future? What do you think about that?
It's a good question.
Yeah.
I mentioned the one con, which is you need patient capital. This is not a short-term strategy. I would say the other, as far as regulatory, the law, the tax law that these are based on is long-time solid tax law. Okay, there is nothing aggressive in these types of designs. Now, there have been some aggressive uses of PPLI. Some of it has been offshore PPLI, which we do essentially no offshore.
Why would somebody want to do an offshore contract?
Because they may want to do something more aggressive than what the onshore companies will allow or the onshore tax status would allow in terms of the underlying types of investments. There are two main issues dealing with private placement. One is called diversification. There are very clear guidelines as to the amount of the diversification that needs to be within the contracts. It's easy to satisfy. It's not a hard one at all. The main issue is investor control. The client cannot dictate which assets to buy and sell. So I'll give you an example. The client can hire an investment advisor to manage the funds. They can prescribe the types of investments. They can get reasonably detailed into the investment policy statement and what that includes. But what they cannot do is tell the advisor who's managing those PPLI assets, they can't say, sell Microsoft and buy Apple. You can't do that. Okay? They cannot have undue influence over the selection of the underlying investments. There has to be enough arm's length, okay, so that it is not deemed to have investor control. Mm-hmm. You want to avoid investor control. Now, the other alternative to using a separate account management approach is using what they call IDFs. And the insurance companies have established many different IDFs managed by the likes of, Golub, Ares, Millennium, Alkeon, et cetera. And these are funds. Think of them as mutual funds, mm-hmm. okay, but of alternative strategies. So that is the other way that the funds can be invested in a PPLI. We see most clients wanting to utilize their own advisor in a separate account program because that advisor has a broader selection, a broader array of investments that they can bring into the private placement.
And
sorry for getting a little long-winded.
No, it's good to get into the nitty-gritty. That's why we have you here, because you're the expert.
I don't know about that.
You've been doing it for a while.
For a while.
We won't mention how long.
We won't mention how long.
No, but I think that's one of the reasons that we've been able to work together so well, Vivaldi, in your business is you bring this level of expertise of doing it and understanding the space so well and the partnerships with insurance carriers. And we bring the expertise of being able to invest in various alternative investments and having a very robust platform where I would say most wealth management firms don't have that capability. Yeah. So it's really an interesting space. We have the right clientele for it. And I think we'll continue to work more and more doing these types of solutions. So outside of PPLI, just kind of as a final note, I'm curious to get your thoughts on the future of insurance. Anything to note? Anything that you're excited about? Given your experience in the space.
Well, I think I've seen the gamut. I've seen the evolution of the industry for a long time, and there was a movement towards guarantees, the importance of underlying guarantees. That's still there. The insurance industry responded well to the need for guarantees and clients wanting more assurance that what they're buying is what they're getting. But we've also seen a lot of growth in the variable type of space because clients want access to the breadth of the market. What makes private placement attractive is the ability not just to invest in stocks and bonds and commodities or whatever, mm-hmm. but to also be able to invest in their insurance contract in alternatives. So I think that's probably been one of the, quote, exciting areas we've seen growth in.
Yeah, similar trend in wealth management as well.
Yeah. And the other thing I'd say is that we've seen a lot of interest in maximizing wealth transfer, using insurance vehicles for long-term wealth transfer, multi-generational type planning. We've seen a lot of use of that.
Yeah, that'll likely continue.
That will likely continue, yes.
Well, I appreciate your time, Jordan.
It's been a lot of fun. Thanks for having me.
Yeah, you as well.